Barton Biggs with us, and we usually talk long, short, we talk emerging market or U.S. markets. No, today it's book club with Barton Biggs. It's a great book, A Hedge Fund Tale of Reach and Grasp, or What's a Heaven For? There's a book, you can see it there on my desk here at our world headquarters. It's just the right size, Barton. Why did you write a book of fiction about hedge funds?
Well, because if I'd written a book about fact and about and a book about how guys blew up and how their reach did exceed their grasp, and the sort of the human tragedies of the financial crisis, a lot of people would have gotten very mad at me, and
right.
So I wrote it in fictional form.
Let's bring up this quote. It's on the cover of the book. Robert Browning, thanks to Casey Herzog's surveillance poetress. Andrea Del Sardo, but a man's reach should exceed his grasp. Or what's heaven for? I mean, Barton, this is the reach that everybody does, the hope and prayer of the equity markets. How do you not fail at equity investment? What's the trick to longevity in investment?
Well, I think the trick to longevity is that there's two tricks. One, you've got to in the long run perform. It's like being a professional athlete. You can't fool the markets just the way a professional baseball player can't fool the world about his batting average. But you've also got to have the endurance to hang in there, and all the great hedge fund managers, in which incidentally I do not include myself, have all had at some time taken a really big hit. But this novel is about a couple of guys that made it on their own, but then took the big hit, but the hit was so big and that they couldn't survive it.
You've got to.
Yeah.
Well, go ahead, Barton, please.
Well, no, I mean, I'm also talking about, and I don't want to go abstract on you here, but the tragedy of the commons. That tragedy of the commons is the theory back in England that when you have a commons and it's got rich grass and 2 or 3 people bring their cows to graze on it, the cows get fat and everybody does well. But then, as other people see that they're getting rich from it, they bring their cows onto the commons, and then there's, instead of being 3 or 4 herds on the commons grazing, there's
right
15 or 20, and they all starve, and that's what happened to these guys running very skillfully a quant value-oriented hedge fund,
well,
they were.
You've got here, Barton, in A Hedge Fund Tale, Joe Hill, who starts out basic in the Carolinas. He does well. There's a point in the book, a tipping point, where he moves to Greenwich. And you essentially say, and then they move to Greenwich, Connecticut, for those of you worldwide, northeast of New York City, and where you go when you've made it big. Is it good to move to Greenwich, or is it bad? Is there a herd instinct there where everybody thinks the same?
No, I don't think there's a herd instinct there, but in the heyday of the hedge fund boom, the joke was that the speed limit in Greenwich was 2 and 20, and yeah, everybody, there's an awful lot of hedge fund money in Greenwich bidding up the real estate and taking the places in the private schools, and so it was a big deal.
You got some charts in here. Folks, it's fiction and there's charts. How cool is that? One of them, Barton Biggs, is IBM, and you show the doldrums, the malaise of IBM going back from 1980 on to 1993 or 94. Your character, Joe Hill, gets out of IBM just before the big boom. How do you, day to day, in the Traxis Partners world, how do you work so that you avoid getting out at just the wrong time?
You're asking me questions that are way too hard. I mean, and we don't. A lot of times we get out just before the big boom, and that's the tough thing about this business. And I was just reading the new book, More Money Than God, and he describes in there how these great hedge fund managers would get whipsawed. They would get out at the wrong time, and then the thing would take off, and they'd get back in again, and then it would collapse. So they got a double whipsaw on these things, and that's life itself in the investment world.
And that's Sebastian Mallaby, folks, More Money Than God. It's a great book. I really, really recommend that on the real world of hedge funds.
It is a great book.
Getting back to your idea here, Barton, the way I would do it technically is it's a type 1, type 2 world. And by that I mean, folks, if it's a type 2 world, you want to be always thinking about what not to do. The herd instinct is do this, do this, do this. You got to walk in and say, okay, today I'm not going to do this. Right now, Barton Biggs, what are you not doing as we enter February of 2011?
Well, I guess what I'm not doing is I'm not selling, and I'm not panicked by these events in Egypt and the Middle East.
Barton, when you look at the idea here of what's heavens for, there is always that desire of doing better. What would be an appropriate return for a hedge fund right now? Is it a high double digit, or do they got to bring it down a little bit with this changed financial landscape?
Well, that's another one of your really tough questions. I mean, look, I think if
no, go ahead, Barton.
If a hedge fund can return after fees 10-12% a year over the next 5 years, I think that'll be terrific performance.
Barton Biggs with us, folks, in celebration of fiction, a hedge fund tale, quoting Robert Browning, among others, at the beginning. Barton Biggs, page 311. Meanwhile, out there, the stock market rally continued without mercy, cruelly indifferent, thumbing its nose at them. Boy, have we climbed the ultimate wall of worry here, Barton Biggs. Are we going to continue to climb the wall of worry in 2011?
Yeah, I think we are. I mean, I don't know how high up the wall we're going to climb, but the ongoing high frequency economic data is very encouraging, and if the S&P is going to have in the next 12 months is going to earn close to $100 a share, which is not at all inconceivable. The estimate keeps going up. It's up to about 92 in the consensus now. Then could the market sell at 15 times earnings? Yeah, I mean, could we make a run for the old highs? It's possible, but as we've talked about before, Tom, I mean, I'm still worried about the U.S. housing market,
right?
And the Case-Shiller stuff shows that there's still a problem there. So we got to watch that very carefully. I
want to bring in a Paul Krugman op-ed with Barton Biggs' comment on housing here. Let's bring up the Krugman op-ed, please. The New York Times, across of rubber, commodity prices are up, but that's no reason to perpetuate mass unemployment. To paraphrase William Jennings Bryan, we must not crucify our economies upon a cross of rubber. Barton Biggs, you mentioned the housing debacle. How do you link day to day the optimism on corporate profits, the optimism of good returns since March of 2009 with the macroeconomic pain that's out there?
Well, what you have to hope that what Bernanke is doing in QE2, flooding the U.S. and the world with liquidity, is going to turn around the market for existing single-family homes in the U.S. Because if it doesn't, and if prices of those homes keep falling, the consumer is not going to keep spending at the rate he is now. The savings rate is no longer going up. But if housing, which is almost 2/3 of his net worth, continues to decline, he's going to start saving more because he's worried about his pension, he's worried about his Social Security payment, and so on. So and so you just got to hope that the good old stock market is smart and perceptive, and the stock market is seeing and saying that what Bernanke's doing is going to work.
Right. The consensus here, Barton, has been towards smaller stocks. This chart, folks, is the ratio of the NASDAQ 100 to the Dow. You can see the big boom in the OTC space in the late 90s, but recently up it comes again. Barton, do you like blue chips, or do you still have to be more nimble in work with smaller cap stocks?
Tom, there isn't any question that that the real values in this market are in the big, high-quality multinational growth companies, and the small cap indexes have had a huge move. So I would definitely be betting against them and betting for the big caps, the big cap, high-quality stocks.
Well, then, if you look at Egypt, you mentioned Egypt earlier. Do you go in and buy the 2 or 3 biggest companies in Egypt? What is the signal for you to reinvest or marginally new invest in Egypt, given these protests? When do you go into, I believe it was Eastern Tobacco, Justin Leverance was talking about?
Geez, honestly, I've never invested in Egypt. I don't know very much about it, and I have no idea what the signal would be. But a 16% decline in a market that has been a pretty darn good market over the last 3 or 4 years,
right,
it certainly doesn't restore value.
Let's talk.
So I'm not there in Egypt.
Let's leave it, Barton, then with gold. Gold has come back 7.5% or so from the beginning of the year. Your former colleague in Kai, Byron Wien, is talking up higher gold, a 5% yield, a little bit of inflation coming in. Do you collegially disagree with Mr. Wien? Are we going to? Is gold going to finally give it up and move flat or down for the year?
I'd like to ask Byron, well, what's the PE ratio on gold? Well, what kind of price to book does it sell at? What's its yield? And so I think gold is a purely psychological investment, and the way I look at it, it's had a tremendous move, and versus the inflation and monetary indexes, gold is very extended. But that's not my game. It's not my game to try and think the gold bugs.
Right, Byron. Excuse me, not Byron. Barton. Thank you so much.